The United States has unveiled a fresh round of tariffs impacting its global trading partners. And while Canada escaped those reciprocal tariffs, we're not totally unscathed. Joining us now to discuss is Derek Burleton, VP and Deputy Chief Economist with TD Economics. Derek, thanks so much for taking the time to talk with us.
My pleasure.
So as I said, we were watching, obviously, the developments in the Rose Garden live. We were saying, at first blush, you're like, where's Canada on that list? It seems we have escaped this latest round, but we already had some tariffs in place. What does it mean for the Canadian economy? Does it change our view of where we might be headed?
Well, yeah, I mean, best deal in a bad deal, but I was braced for more tariffs yesterday. We didn't see them, no net new, but we're still dealing with pre-existing tariffs, steel and aluminum on the auto sector. But I think even more, it's the uncertainty. Hearing news that Chrysler is going to shut down for a couple of weeks in Windsor, given the Windsor assembly, given the uncertainty around tariffs. So you're getting impacts. But, for us as forecasters, we had built a lot of that into our March forecast out a few weeks ago. We actually had a steeper tariff assumption than looks like it's going to happen, at least for now. We had 12.5% average tariff rate on Canada. Based on yesterday's announcement, what we know, that's looking heavy. But then I still worry about further tariffs on copper and some of the other areas. So for the most part, it looks like we avoided the worst. I worry about uncertainty impacts. It's certainly going to slow growth in Canada, and worried about potential escalation as well going forward.
I know before yesterday as well that your team had done work on the potential government supports and what they could look like. Anything about what's happening right now that has changed your mind on that front?
Well, the two things I'm watching Retaliation, and some of the early word we're getting on Retaliation is it's going to be very targeted on the U.S. auto sector from Canada's perspective. So we'll see, how that rolls over in the United States, but hoping, that's okay. But then that was expected. But in terms of fiscal response, if anything, we will get quite an offset. You get an offset from a number of areas. You get an offset from lower interest rates. Canada's been very quick to cut rates. You get an offset from a weakish Canadian dollar, which actually, as of right now, is showing resilience. But, we do have a soft dollar in our Canadian dollar in our forecast. But as well, the fiscal response looks like it's going to exceed our expectations. We had 1% of GDP, largely to support impacts from the tariffs. Provincially, we're already looking at that when you build in a likely Ontario response in its budget. Plus, you have all the election measures federally. And I think it's going to give the economy a bit of an offsetting lift. So hopefully, we avoid kind of a significant recession in Canada. We might even get by with stagnation, even some mild growth this year.
How much further can the Bank of Canada go? They have been delivering those rate cuts. We did have inflation back down to target. It's picked up a little bit. How much room do they have for the rest of this year to give more rate relief?
Well, they don't have a lot of room, but that's under a scenario where the economy doesn't encounter very, very steep headwinds, as we're not expecting at the moment. But all that to say, we had two cuts in our forecast this spring. Maybe a bit delayed because I think, Bank of Canada is going to be looking at some upward inflation impact from Canadian tariffs on the U.S. They've got to kind of walk the tightrope there with some of the weakening economy. I think certainly by the late spring, it's going to have enough evidence that the economy is weakening to cut rates two more occasions. And it'll stop there, provided that, again, we avoid sort of weaker downward scenarios that we're not currently embedding. So I think two cuts. That'll get short rates down to 2.25. And I think should be enough to kind of provide some of the underlying support to keep the economy from its head submerging too much.
Even though we are in this tariff environment, of course, as goes the U.S. economy, often goes the Canadian economy. When we take a look at the actions that have been taken by the Trump administration, what are your thoughts on the U.S. economy?
Well, that is weaker. And, but we had an expectation for the U.S. that was quite upbeat for this year. Sort of the trend was your friend there. The economy had, doing well quarter after quarter. We had assumed slowdown, but nothing too sharp, something closer to trend 2%. Now, with the yesterday's announcement, we're certainly looking at a deep downgrade to that growth outlook, at least 0.5 point. Still positive for 2025. But 2026 could also get marked down. So certainly a much weaker U.S. forecast just based on deeper tariffs. and uncertainty. And the job numbers tomorrow will be very key to give us a better sense of starting position. So we'll see what those numbers are like. But overall, yes, we're looking at taking a cleaver to the U.S. outlook in our next forecast. And, that won't help Canada. That's one of those, along with weaker commodity prices, you got to factor that in any Canadian equation. But with fiscal stimulus and the tariffs not being as steep as some had expected, I think there'll be some offsets there.
If the aim here of the U.S. administration is to reshore, to bring manufacturing back to their country, what does that actually mean in terms of cost, timeline?
Well, I think the end goal is having the U.S. Supply its own needs as much as possible, and so a major shift, obviously, from the status quo, several decades of globalization. How long that takes, I think there's certainly limits in the near term. You might get some increased capacity in the auto sector, for example. But again, you can't just move over quickly. Auto plants are designed to supply certain vehicles. It would cost billions of dollars to retool. And then you've got labor shortages. And that's going to be, I think, longer term, a bit of an issue, I think. So we'll see. I think the 2 to 3 year time frame is often given as when you can get significant investment response. We in our commentary note that by 2027 you could get 500,000 more jobs in U.S. manufacturing, which relative to the size of the economy isn't massive. And the cost per job, given the cost of tariffs, would equate to about $1 million a job. So given that robots and everything will be housed in a lot of those manufacturing facilities, there's certainly limits there.
Before I let you go, Derek, I want to ask you this reordering, really, of the global economy like you're talking about. What do we think about the global economy? Is there still a lot of dominoes to fall before we can figure out what the wide-ranging effects are?
Yes, we're talking from a very early stage. We've got to see retaliation. I worry about, for example, Europe retaliating on U.S. services, intellectual property, digital service tax. That could take this trade war to a completely different level, given the U.S. have threatened tit-for-tat responses to retaliation. So a lot of potential headwinds there. Financial markets could be another headwind. So we have to sit back, monitor in the coming days. Hopefully some cooler minds will prevail. And, in a best case, you get trade deals with the U.S., you got a U.S. administration that wants to shift to tax cuts, kind of the next stage of its agenda. And hopefully we will see a number of deals fall in the coming weeks and months, and that'll kind of soothe a little bit of the nervousness right now.